Well, if I can be allowed just a personal note, it's good to be home. Thank you. It wasn't an applause line, it was sincere. I'm very grateful to Carla for doing such a wonderful warm welcome as well as chairing this session. Fred Bergston had to be away for a family reason, but he sends you his regards, of course, here in the Bergston Conference Center. If I can make one more sort of institutional note, I am very proud that my first hire, our first hire now, is Dave Stockton. I think you all just saw why. And this is, we saw last week, we had two marvelous fests celebrating the careers here and throughout of Morris Goldstein and John Williamson, who contributed so much both to the Institute but also to the global economy. Those people are never replaceable, but the Institute continues to grow and thrive, and we are getting our new generation in, and there will be a couple more exciting new scholars who will be introduced to you over the first half of 2013, and so I look forward to doing that, as Carla said, from this stage. Back to substance. My title, Euro is Going Nowhere in Two Senses, is pretty straightforward. A, the euro is going nowhere, the euro is not going to disappear, the euro is not going to break up and go away in a way that I got used to hearing constantly in the City of London over the last few years. But B, in growth terms, the euro area is going nowhere also. It's going to completely stagnate, maybe have some mild growth in my opinion, but probably have near zero for the next couple of years, with obviously that being mild positive growth in Germany and pretty horrible ongoing recessions in the periphery. So bottom line, that's the 2 points I would make. To expand on that, why do I think this is happening, what's going on? Well, we're looking at a 2-year horizon, and the 2-year horizon is dominated by macro policy. And we have a macro policy situation, where the ECB has, I would say finally, stepped up and provided some conditional ease to the Eurozone and stopped, to some degree, a panic in the sovereign bond market, and that has put a floor under growth. At the same time, we have a large number of governments, perhaps for very good motivations, but with bad effect, pursuing very strong austerity programs simultaneously in a currency area, and that puts a very low ceiling on growth. There are other factors there. There are structural factors, there are banking factors, there are confidence factors. I'm happy to talk about all of them. But the dominating message I want you to take away today is policy right now, which is very unlikely to change in any meaningful way in the next year at least, is bracketing euro area prospects. From the US point of view, from the global point of view, in some ways this is good. We are not going to be seeing the kinds of idiosyncratic shocks coming out of the euro area, the kinds of uncertainty and general problems of transmission that we had to keep facing or fearing over the last 2 years. Sitting there at the Bank of England, as I was doing until 3 years ago, there were 2 periods, you can probably guess when they were, when I felt like I was one of those British Tommies in a World War I movie, you know, strapping on my tin helmet, waiting for the balloon to go up, as the saying goes, and go off to fight the good fight for no purpose if the Eurozone went kablooey. I am reasonably confident, and I wish I could be confident of more than this, but I am reasonably confident we're not going to have a kablooey in the next 2 years, and that is good news, reduces uncertainty, but we should not be happy about that, is what we've ended up with. So, to expand just briefly on those points, and I will throw in some numbers, I think the place to start is just to recognize that macro policy is still powerful. There was a very nice FT op-ed the other day by, I think, Bruce Bartlett, talking about the pointlessness of macro policy. I admire Bruce's bravery in telling truth about taxes, but on this one I disagree. And you can just see this within the euro area. So the red bars are the ridiculously low interest rates that were being charged the periphery countries on their bonds prior to the crisis. The blue bars are the spreads, or rather the interest rates that were being charged by these countries on their government bonds in the height of the crisis or in the middle of the crisis. And the green bars are what's happened since the ECB made its commitment. Putting it a little more clearly, this is a time series. There's some anticipation in financial markets, but just, is there a thingy on here? No, that was the wrong thingy. Okay. This is the thingy. Thingy's shut off. No, there it is. Okay, you see this? That doesn't look like much considering where Portugal was. That's 120 basis points. Right here, the blue line, Spain, that's over 100 basis points. These are very, very substantial movements in official sector rates when nothing fundamental had changed, just the ECB stepping up. This is a very big deal. And I will return to the question of could they have done more and could they have made a bigger deal. But macro policy here works. Now, we can also talk about the fiscal commitments, and I will get to that in a moment. But what is important to recognize is that we have consistently, and when I say we, I don't mean me, of course, I mean the economic community, economic policy community, the people in the central banks, the people in the forecasting business, have consistently underestimated the multipliers on fiscal policy in the recent times. And just now, thanks in part to the leadership of the IMF on this issue, thanks in part to some independent voices, many of you know, I hoped I was one of them, we've been out there saying, come on, whatever your ideological disposition, whatever your concerns about the future long-term debt levels, which are legitimate, you can't deny the reality that when the interest rate is at zero, when the economy has lots of slack, when there are financial disturbances still in the system, that multipliers are going to be greater than 1. And yet policymakers in 2010 and 2011 to a surprising degree did test that. And that's part of the reason, frankly, why forecasts were wrong and policies were set wrong. And again, this is not to say we never have to pay off the debt. This is simply to say if you're going to make realistic forecasts, if you're going to make realistic policy plans, you have to take into account what really happens. Now, Dave had mentioned during his talk, and I know he's thought about this deeply, some of the reasons why, beyond that list I gave you, why multipliers are going to be particularly big right now. In the euro area, we have one notch further, which is you have a bunch of tightly tied together economies doing it all at once. Now, this is pretty simple algebra, and it's certainly far from optimal. Because instead of having a spillover in your policy dissipates, you have a reinforcement of your policy, and you even have a competitive aspect. There's a least ugly contest. I want to prove I'm not Greece. No, I want to prove I'm not Greece. Well, I certainly am not Greece. And suddenly everybody is doing extremely rapid consolidation. Now, my colleagues, there are a number of people in this building, as you're well aware, who work very well on Europe. In particular, we all need to recognize that Jacob Kierkegaard has become to Europe what Nick Lardy is to China. Everybody's go-to person, and deservedly so. And Jacob will tell you that there is real structural reform going on in these countries, arguably as a result of the tight pressures enforced by these policies. And our other colleague, Anders Asland, has been out there arguing something similar, pointing to the example. He's done some very interesting work on Latvia and how that has worked in Latvia. And so you occasionally, I'm not going to quote these people, but you will, my dear colleagues, but you occasionally get people with a variant of what Dave called the benign cliff. This is a good thing. This is getting us forward. Well, we can debate the merits of it. I'll get to that if people like in the discussion. But as a forecasting matter, let me reveal to you the dirty little secret. These structural reforms will not yield any benefits unless there is a recovery in the euro area. When Germany reformed its labor market in 2003, 2004, and they did so bravely and radically, and they did get lower long-term unemployment as a result, but they did not see the benefits until there was a global recovery and growth was above potential in Germany. And if you keep going with your structural reforms in a period while you are defeating any chance of expansion, then you get the labor market problems that Dave was talking about. So this is a chart of the youth unemployment rate And I should have labeled 100 minus employment rate means the participation, the decline in the participation rate. Okay, these are changes. So the youth unemployment rate, as we all know in Spain, is hideously high. We can tell all kinds of stories about how it's not so bad to sit out in Malaga and your family looks after you. But the income scarring, the professional scarring is for real. These are all numbers that are simply extraordinary, okay? Minimum of 12% rise in youth unemployment. Now, many of you are familiar with these figures, but I want you to just get in your head what the scale is. And so if Dave can rightly, in my view, raise the issue of what is the long-term damage to the US economy, to US labor force, to US growth prospects from an unemployment rate of 8%, a youth unemployment rate of 15%, what is the damage to these countries? Similarly, participation, the chart Dave showed you, if you went down that trend from Fed Chicago, you're talking about a participation rate drop in the US of what, 2.5%? Okay, the smallest one we're talking about here is Italy at just under 2. Portugal is 5. Ireland and Spain are 8, 9, 10% drops in participation. This is extraordinary, and this is a reason why I fear that most forecasts for both potential in the euro area and forward-going growth in the euro area are still too optimistic, even if you rule out the tail risk, which I believe the ECB has at least for now done. So I got a bit more here on fiscal policy. I'll skip it over for the moment, get to a nice blank slide so I can go to the next point. One thing where I want to give Jacob and Anders, among others, credit, although they're among the very few in the US who saw this, was Jacob and Anders were out in front saying the political sustainability of these kinds of austerity programs is going to be much higher than you expect. And they were right. You know, a number of us, myself included, thought riots in the streets in Athens, protests in Madrid, you know, how long is this going to go? Well, the answer is quite a while. And the answer is some of these places do re-elect parties that are center-right, not radical right, not horrible, who do want to actively continue austerity. And that means, however, that just because it's politically sustainable does not mean that it is beneficial. And just because it's politically sustainable does not mean that it's inevitable. So what you're getting is large sections of populations in these countries that are becoming disenchanted, disenfranchised. Thankfully, it is not the 1930s. We do have welfare states in Europe. We do have the discrediting of racist and other policies. So the people who spun out the nightmare scenarios, oh, it's the 30s again, exaggerated. But they exaggerated the pace. They didn't exaggerate the nature. And it is, remember, if it took Germany to get into political trouble as a result of exchange rate enforced austerity in the 20s and 30s, it took 5 to 7 years before the elections of 1933. We're in year really 3 for most of these Euro countries, possibly 4 for Ireland. So coming back to the forecast real quickly, I'll defer to our friend Minister de la Sella from the delegation of the European Commission. They just issued, and there's a nice reprint of the chart from the Wall Street Journal yesterday, the official forecast, and they quite responsibly, though sadly, marked down their forecast quite a bit for the Euro area and for particularly the periphery countries. I go, for the reasons I said, a little bit further. I think that the Euro area as a whole on net is going to grow at about 0.5% for 2013 and 1% or a little less for 2014. This is because I think the official projections, which are among the more reasonable of official projections, underestimate the depth of the coming recessions in Italy and Spain, or the persistence of them, for the reasons we talked about. I think that means that in Spain in 2014 and Italy in 2014, you're looking at a recession of more on the order of -2% in Spain, -1% in Italy, instead of a full percentage point higher roughly, which is what some people are forecasting. I think it also remains a bit optimistic to think that Germany will return to a 2% growth rate in 2014, which is what the European Commission currently has. Nick Lardy is going to talk a bit about why there may be a short-term continued slowdown in China. in that kind of world, it's very hard to see how Germany sustains. So what happens, in honor of Fred Bergson, to the exchange rate? Well, the euro now becomes essentially, instead of a source of exchange rate risk, just something buffeted by exchange rate risk. For the next couple years, I think it will, frankly, be trading in a much smaller range based on its fundamentals. The 1.3 roughly where we're at now is probably a little high from a competitiveness point of view, but as long as there's successful financial repression, which is what makes the whole thing stick together, that will put a floor under the currency, unless, God forbid, we get the fiscal cliff, the bad fiscal cliff that Dave talked about and that Europe is demonstrating for us. There are some risks, obviously, as forecast. On the upside, I would emphasize three. As a number of people have pointed out, and as Bill Klein has pointed out, particularly with respect to public debt sustainability, Spain's fundamentals going into this crisis were quite good. Obviously, unemployment, labor market was not perfect, but you look at the actual productivity growth, the state of public finances, the strength of the main banks, not the small banks, not the cajas, but the main banks, the export competitiveness, Spain was a good economy. And so there remains always the hope and the possibility that if the rest of Europe were to cut Spain a bit of a break, Spain could come back strong. And to a lesser degree, you can argue that for Ireland. Ireland, it really is, you have to get rid of the pernicious debt. And we don't know whether that's going to happen or not. A second possibility, which I put a low probability on, is that the ECB takes their conditional commitment to do their so-called OMTs, to intervene in markets of governments that have undertake a program, and runs with it and does it very aggressively. I would put the odds at this extremely low, even though President Draghi there is finally saying some things about the fact maybe inflation isn't really a threat. The third possibility, and I'll defer to my colleagues Nicholas Veron and Jacob Kierkegaard about this, and as usual in Best IAE Forum you can hear them debate it, is whether the banking union becomes a form of real mutualization and fiscal transfers in the near term. And that's very contingent on the German political situation. Again, I'm happy to comment on that. I will simply say as a matter of forecasting, the odds of us getting, except for a one-time goodie for Ireland, any bank mutualization in the next 2 years I think are very low. And if we don't get that, then you're not getting the necessary fiscal transfers or bank bailouts. You're not breaking the sovereign bank law. Downside risks, I've stressed the good news that I think a lot of them have been taken away. There remains the possibility that Greece, something really messy happens in Greece and we redenomination risk runs riot. I have to believe if there's any sense in financial markets, and I've got a few sensible friends out there, the only people with money left in Greece are poor people in Greece. There's also a possibility, as I've discussed with some colleagues here, that if Spain goes into a program, particularly since they have a lot of money to roll over in the early part of 2013, that there could be some mess up of the handoff either between the ECB, the IMF, the Commission, the Troika. I put a low probability on that, but I think that if you want to look for an event risk, that's the moment to look for an event risk. Let me conclude. Carla, at my bidding, not realizing how long-winded I would be, suggested we might say some things about US challenges. I will be very brief on that and happy to address it in the session. I think the US has much less to fear from the euro area and from euro area problems now and going forward than they did for the last few years. For the last few years, it was a serious matter. Now it is an unfortunate matter, but not a serious one. And that, for those of you long enough have long enough memories, will recognize that's Japan. It ends up being Japan of the 90s. It ends up being a drag. It ends up being something that interferes with activist global diplomacy in the economic sphere, because a country that, for all its problems, on balance is usually a partner for market, a partner vis-a-vis China, a partner vis-a-vis rest of the world, is just not activist and is, if anything, tooling up a bit its mercantilist ways to try to get some growth. The sad thing is, Without overt crisis and financial vulnerability, you're not going to pay that much attention to a decaying, declining country. And in the euro area, it is not a decaying, declining area, but when everybody talks about China and everybody talks about pivoting to the Pacific, this will reinforce that trend. And that is unfortunate for the values that Europe and the US share in the economic and other spheres. What can you do about it? We have good friends here from the State Department, the White House, the Fed, and they've been around long enough to know that when a rich country over whom you have no leverage is on a self-destructive path, all you can basically do is keep working on them, trying to persuade them that they're doing something wrong. And this is the place where the Obama administration, I think, does have a challenge, which Congress doesn't have that much of a role in. You may have to pick winners. You may have to decide the person in that party in Germany or that party in France really does have more sense than the person in the other party. And that was a big thing we did with Japan in the early 2000s. I worked with Glenn Hubbard, who was then at the Bush CEA, and we reached out very strongly to Heizo Takanaka, working for then Prime Minister Koizumi, which was one faction in the Japanese system. And the fact that Koizumi and Takanaka came in and then appointed Fukui at the Bank of Japan led to a reversal of bad policies there. And that led to, even though nobody seems to remember, very solid growth in Japan from 2002 to 2008. We may have to, at that level of diplomacy, be thinking about who you're backing, who you're siding with, who you're encouraging in Europe, because the alternative is stagnation and decline, which may not be anything that's going to get you up the top of the president's agenda, but we don't really need Europe slipping to the bottom of the president's agenda. Thank you all very much.